Welcome, everyone. Thank you for joining us. My name is Sofia Salgado Robitaille. I'm the Executive Director for the Southwestern College Foundation. It's a pleasure to be here with you today. I wanted to start by giving you an overview of what we've been up to and ways you can engage with the foundation. So we have three main programs. It's all benefiting Southwestern College students, our scholarships, our mini grants, and our CARES emergency grants. So we grant about $300,000 in scholarships every year to support students and help them stay focused on their education. And then the mini grants support special projects that students and faculty want to embark on, whether it's a leadership conference or having a special speaker for a class. We cover those extra expenses. And then we have our CARES emergency grant program, and that's for any emergency that comes up. So we support it's assistance with housing and food and textbooks. So basically our mission is student success. And we can't accomplish our mission without you, our partners. And basically we want you to have the tools and the resources to have financial health. Thus our estate planning session here today, which we hope adds value to you as our partner. And if you have any ideas on future topics or webinars that you'd like us to cover, please share them with the foundation or type them into the chat box and we'll monitor that. But financial planning is so important and sometimes may seem so complicated. Our webinar today will give you an overview of estate planning and how it affects your future and your family's future. We have a lot of great info, so feel free to grab a pen or a pencil and some paper. We'll have some time for a Q&A after the half-hour presentation. So again, type your questions in the chat box and we'll make sure to answer those at the end. So let me introduce you to our awesome presenters who happen to be our foundation board members too. Daniel Guillen has over 25 years of experience in the wealth planning industry. He believes that there is more to retirement planning than numbers alone. It takes commitment, effective communication, and trust between advisor and client to design a vision and map out a strategy. And it requires the experience of a competent advisory team to execute the strategy over time. Mr. Guillen has extensive experience counseling on investment management, personal stewardship, retirement income planning, estate and tax planning, charitable planning, and much more. He's a graduate of the College for Financial Planning in Centennial, Colorado, and he's currently pursuing his designation as a certified financial planner. Next, our other presenter is Benjamin Green. Ben is an experienced trust and probate attorney who has advised hundreds of personal representatives during the administration of estates and or trusts, both court supervised and non-court supervised. Mr. Green also practices in the areas of business and real estate transactions and has counseled many families on business succession planning issues. He's a graduate of UC Berkeley with a degree in business administration. Then he continued to the University of San Diego for his law degree and ultimately a master's degree in law. Mr. Green also is fluent in Spanish. So quite an impressive duo, right? I thank you so much, Daniel and Ben, for sharing your expertise with us today. And I'll let you take it from here.
So thank you for joining us today. As we've mentioned, my name is Daniel. This is my friend Ben. And we'd like to share with you a little bit about estate and financial planning. So a friend of ours, Benjamin Franklin, mentioned nothing in this world can be certain except death and taxes. And we both believe that. So can you answer these questions for us? What happens to my assets when I pass? Am I leaving a big mess for my family to clean up? Are they really protected? How do I protect my assets from rapidly increasing healthcare and long-term care costs? Can I pass my assets without court administration? And how much does all of this cost? So it's part of what we're going to be here to try to answer for you today. So first, an introduction to estate planning. And who really needs estate planning anyway, Ben?
Really, everyone could benefit from some type of estate plan. Depending on your level of assets and your family situation, you may be able to do something as simple as just setting up a simple will, financial power of attorney, advanced healthcare directive. Somebody with more assets, more complicated financial situation, they may need another type of document, also known as a trust. They may need some type of more advanced planning for their business or other assets, but almost everyone can benefit from an estate plan.
Right. And there's different benefits. So while you're living, estate plan can help you simplify what some people can consider a complex process of estate planning. It allows you to control how your assets are put together and then ultimately how they're distributed. Allows you to document your intentions, which is extremely important. Allows you to designate who gets your benefits or what you've worked really hard for, and allows you to appoint the right people to help you manage your affairs now and when you pass. And so if all of that can be done in a way that you're comfortable with, hopefully it will also provide you with peace of mind. And then upon your passing, what estate planning does for you.
Sure. So one of the major ones in California, depending on what type of estate plan that you've set up, hopefully your beneficiaries will be able to avoid a court process known as probate. Also, that will save them significant costs, significant time period in terms of the administration of the assets. And by setting up the estate plan, ahead of time, you're going to designate who you want to be in charge of distributing these assets to your beneficiaries, and also, who should receive what. And the plan that you set up may be very different from the California probate code, which is what happens when you haven't done a will, you haven't done an estate plan. So it can be very important.
Right. And for those of us who are entrepreneurial and maybe have some businesses, all of that planning process should happen obviously prior to our death or incapacity, and to ensure that our business can succeed after we're gone. So incapacity, so that's when we no longer can make decisions for ourselves, right?
Sure, that may be decided by the court. It may be decided by, depending on the type of document that you've set up. Typical one is 2 doctor's letters signed that you no longer have capacity. But the bottom line at that point is you're no longer able to make medical decisions for yourself. You're no longer able to pay your bills, make financial decisions. But if you set up an estate plan ahead of time and it includes, a healthcare directive or financial power of attorney, you can actually name in those documents who you want to take over. Who would you want to be making those financial decisions for you? Who would you want to be communicating with your doctor and directing your medical treatment? So that's something that you can do ahead of time and avoid a court process where people would be fighting about who that person is. The judge would be interviewing people to make that determination. It can be very expensive and cause a lot of grief.
Yeah, so that sounds like it could be a mess. And so essentially with the estate planning process, you can handle all of that in advance, appoint those people that you would suggest to manage your affairs while you're living, not just your financial affairs, which are very important, but also your healthcare affairs. So we're also going to talk a little bit about taxes in estate planning. So we believe proper estate planning can help mitigate, reduce the impact of taxes upon our passing. So we're not going to go over all of it, just going to cover the income taxes, the capital gains taxes, gifting and other inheritance taxes, and ultimately the estate taxes. So beginning with income taxes are due in the year that we pass, just as would normally be due. You're going to have a tax return filed, and so in the year that you pass, not only are taxes due on what you earned, but they're also due on what you left in your estate, so whatever your estate earns. And so we want to make sure that we are careful to plan for that and make sure that our heirs have sufficient resources to cover those income taxes that might be due. Then there's capital gains taxes. And so what is capital gains and how does it impact us?
Sure. So, any asset that you own has what's known as the cost basis, which is typically what you paid for that asset. When you sell that asset, the difference between the sales price and your cost basis, that typically results in either capital gain or capital loss. So when someone passes away, there's a major tax benefit when your heirs receive an asset by inheritance, which is known as the step up in basis. The way this works, it means that upon your date of death, your heirs will receive whatever asset, a house or shares of stock. The cost basis for that asset will be stepped up to the fair market value on date of death. So the practical result of that is you're selling mom's house or you're selling shares that you received by inheritance. there will typically be no capital gains to very little capital gains, provided that takes place within, say, 6 months after the death of whoever passed away. And that contrasts with gifting the asset. When you gift the asset to your beneficiary, meaning you give it to them during your lifetime, they take what's known as a carryover basis, meaning they receive the same cost basis that you did. So you think of mom again. Mom has a house that she purchased for $50,000. It's worth $1 million now. Common planning mistake we see, or lack of planning mistake. Yeah. Someone may go ahead and gift that property to a beneficiary during lifetime. Now all of a sudden that child's cost is also the $50,000. Instead of the stepped up basis to the $1 million, they go to sell it. There's a $950,000 capital gain. It could be a very unfortunate result.
So again, gifting, which is something that we see commonly used as a strategy with family members, could have some benefits. Obviously, there could be some tax implications that we're not considering. And so it's important to make sure that we're speaking with the right experts to help us through that. Versus the inheritance, if we allow our children or our beneficiaries to inherit an asset, like Ben was mentioning, something like the step up in basis, there could be other advantages to allowing them to receive their assets that way instead. The gift tax, and so there is a tax potentially that people would owe if they give more than what's freely allowed. But ultimately, there's limits to that, right?
Sure. So in this case, the slide has that $15,000 number. That's not where the gift tax begins. That's where the reporting requirement begins. So if you made a gift of $100,000 to someone in the year, you would need to file a gift tax return the following year to let the IRS know that you made that gift. But the gift tax doesn't actually begin hitting until you've used up your lifetime estate and gift tax exemption, which currently is around $11.7 million in 2021. So it does affect some people. It doesn't affect that many people.
And it typically doesn't involve charities and or spouses. They have other special rules for that, right?
That's right. The spouse is able to receive unlimited assets either upon your passing or upon your death, providing they're a U.S. citizen. And in terms of charitable gifts, provided it's a qualified charity, that you would receive, essentially your state would get a deduction from those amounts of those gifts.
Right. And then the federal estate tax. And so this is the amount that you mentioned that we're able to leave to our heirs throughout our lifetime. Right now it's sitting at 11.7. That's per spouse, right? So
that's right.
23.4. And so not a lot of us will be impacted by that, but those of us that are going to have questions. And so if you're worried about that level, then you certainly want to be able to speak to an expert like Ben to determine what planning processes or what strategies you should consider taking. And then a will. Do you have a will? And if you have a will, when was the last time that it was even reviewed or updated? And has anything changed since the last time that you put your will in place? Like new family members, right? Grandchildren, great-grandchildren. And so what's the advantage, disadvantage of having a will in the first place?
So, we always say, if you don't make a will, you don't make a trust, don't worry. The state has a plan for you. And it's called the California Probate Code. And it basically spells out, if someone passes away without having done this, where your assets will go. And for many people, it's not too different from what their will says, because the probate code prioritizes gifts to spouses and children and differing percentages depending on the type of asset that it is. However, you could think of an example. What about someone that doesn't have kids? What about someone who's not married? You could have their estate going to their second cousins or something like that, people they haven't seen in a very long time, or if ever. And your will allows you instead to determine, who do you actually want to get this asset? A friend, a charity, somebody that you're closer to. Also allows you to nominate what's known as the executor, meaning the person that would have the authority to administer everything and make sure those gifts are completed.
Yeah. So there's going to be people that you certainly would feel like you may want to make sure they do not receive an asset, but then there's also those organizations and charities that you want to make sure that do get, part of your hard-earned dollars because it's part of your values, right? And so again, advantages upon your passing for having it was you get to appoint someone, right? You get to appoint someone who's going to carry out your wishes. and it can also be a way of making sure that what you have set for it is done and administered in a very organized manner, right? Versus not having a will, biggest thing for a lot of people is you lose control, right? You lose control, and in some instances, all children are treated equal. And so essentially, that can be something I'm sure you've seen that not everyone wants, right? And so if you're worried about or concerned about making sure that your assets are left to the people that you say, in the time that you say, it may be important for you to make sure that there's a will in your affairs, right?
Another major aspect of the will, for those that have minor children, they're able to name in the will, nominate a guardian, meaning who would have custody of their children in the event that they were gone. It could be also very important.
Yeah. So probate, why is probate so bad, Ben?
It's very expensive. It takes a long time, up to a year, 2 years to administer the assets, depending on what's involved and the complexity. It's something where the process is in the court. It's subject to public record, so your neighbor wants to know what's going on. They can go down to the courthouse and see all these private documents related to the family, which no one really wants that. And it's something, by planning ahead, depending on setting up a trust, some other type of estate planning document, it's a process you can most likely avoid. So
Right.
It's something we recommend to work on
Right.
that.
So it's expensive and can take a long time and get the wrong people involved.
Sure.
So it doesn't sound good. So whether or not you have a will, you could still be subject to probate, right?
That's right. So the will itself does not avoid the probate process. The threshold typically for assets ending up in probate for personal property, meaning cash, investments, tangible personal property like furniture, TVs, the threshold for the case being administered in the probate code is approximately 166,000. That's inflation indexed. In terms of real property, it becomes much quicker. Essentially, any type of real property asset would be subject to some type of probate process. So if you own a home, you definitely want to be thinking about setting up an estate plan that might include another document known as a trust.
Awesome. How do we avoid probate? So gifting, sometimes people have chosen that as a means for them to attempt to avoid probate, but as Ben has mentioned, it's not always the best strategy. Having joint ownership in real estate, so the way you hold title.
Sure. A common technique that a lot of people are aware of is preparing a new deed, and depending on which properties you own, adding another joint tenant or joint owner to the property. The problem with this is a gift that takes place at that very moment, meaning you've all of a sudden gifted today half of that property to your child or your sister or something else, and you don't know necessarily everything that's going on with them. So all of a sudden your property that you had clean title to, no issues, all of a sudden now it could be subject to liens or divorce issues, other things that you hadn't thought about ahead of time. So normally we recommend against the joint ownership.
Yeah, creating problems you didn't know existed. The beneficiary designation. So there are a lot of accounts that you may or may not own, like retirement accounts, life insurance policies, annuities, IRAs. These are accounts that actually have beneficiary designations. And so the institution is obligated to abide by those beneficiary designations. And so that could be a way of sidestepping that probate issue. And then pay on death. So for like bank accounts and brokerage accounts, that's possible one way of sidestepping the probate process, right?
We typically use those synonymously, the beneficiary designation versus the pay on death, yeah.
Right. And so trust, as Ben's been mentioning, trust can be a part of an overall estate plan. So typically what I hear experts like Ben say, trust is considered more like a bucket with a manual. So a bucket that you put things into, and then the manual, which allows the person that you appoint to be in charge of this upon your passing or in your capacity, it allows them to manage it. So either during your lifetime and or afterwards, and then gives them the ability to distribute those things that you put into the bucket afterwards. So trust advantages, Ben.
Sure. So the typical trust document most people set up these days in California, it's a document known as a revocable living trust. This means it's a document that you set up while you're still alive. It's a document that you can change if you decide that you need to. And essentially, while you're alive, You're the person setting up the trust, you're the trustee, meaning you're in total control of the assets, and you're also the beneficiary, meaning all those assets are still for you. What it does, though, is it allows you to name in the document ahead of time in the event that you were incapacitated, could no longer make financial decisions. You can nominate ahead of time what's known as a successor trustee, meaning someone that would be able to make those decisions for you. And that can avoid a court process known as conservatorship, can save a lot of money, a lot of hassle and grief. There's also a place in the document where you can specify where you want your assets to go after you passed away, to whom, and what percentages, and with any conditions that you're planning on imposing.
As well as helping you maintain privacy, which is very important for a lot of us, right?
That's right. The trust document is typically not filed with the court. The only circumstance would be if there was some type of litigation or lawsuit, which is much less common with the trust.
Right. So there's a number of different types of trusts. We're going to cover briefly just 4 of them. What's known as the testamentary trust, the irrevocable living trust, the revocable living trust, the irrevocable trust, and the irrevocable life insurance trust. And so a testamentary trust, when is that used?
Sure. This is a trust that is written out in your will. It was a very common planning technique back in the 60s and 70s. It's not used as commonly now, but essentially at the end of your probate case, the judge would go ahead and make an order for establishing this trust, and it would provide for whatever conditions are there in the document in terms of who's supposed to receive which assets and over what period of time and what condition would cause the distribution. It's very rare that we would use this type of trust today.
So the more common one would be the revocable living trust, which you mentioned earlier,
That's right.
Which is, again, set up while you're living. It allows you to go ahead and start naming and appointing people that you feel comfortable that they are going to understand your values and they will follow your wishes. And so you get to appoint these people to help manage your affairs, again, while you're living, should you become incapacitated, but also, of course, upon your passing, and making sure that the right people get the assets that you've worked hard for. Allows the person who sets this up, you're still managing your own assets. You're not giving them away during your lifetime, right?
That's right. Even in the event of your incapacity, you would have just named ahead of time who's managing that property for you. All of that property is still for your benefit. So if you needed it for your care, your health care, brand, all the day-to-day items, your trustee would still be able to do all of that for you. And whoever's waiting in the wings, someday when you pass away, those beneficiaries would only receive what's left after taking care of you.
Right. And so it's essentially you're setting this document up and you are still the manager of all these things. And because of that, there's no change in the tax implications, right? It's still passed.
Yeah, so the typical revocable living trust is what's known as a disregarded entity for income tax purposes. So that means even though you're setting up this somewhat complicated legal document compared to what you may be used to, it doesn't change your income tax filing at all while you're alive.
Right. So for tax purposes, this wouldn't necessarily be something that people would use to try to set up to reduce taxes per se, but something that is more commonly used potentially to reduce future taxes or taxes upon your death would be something like this irrevocable trust, correct?
Sure. So the irrevocable trust, essentially, it's a gift during your lifetime to certain beneficiaries. Then in that trust document, you're putting certain stipulations and conditions when those individuals would receive that asset. I could think of one example of an irrevocable trust about 10 years ago when Mitt Romney was running. He had set up an irrevocable trust for his children, and he gifted certain interests in private equity companies or investments into that irrevocable trust that at the time only had a value of maybe $1 million. However, over many years, they invested it well. I think it increased to something like 400 or 500 million over a 10 or 20 year period. And because those assets were in an irrevocable trust, there will never be any estate tax or generation skipping tax on those assets. So it could be a really good planning technique for larger estates. There are also some uses for Medi-Cal planning, long-term care.
So it could help mitigate substantial amount of taxes in the future if it's used properly, right? A type of irrevocable trust is the irrevocable life insurance trust. So same concept, basically wanting to take assets out of your estate, but in this case, it's specific to a life insurance policy, correct?
That's right. So what happens with a life insurance trust, Essentially, the life insurance policy that is properly gifted and transferred to the trust, provided the trust has the proper provisions, your estate is not considered to own this life insurance policy. So it wouldn't count against your lifetime estate tax and gift tax exemption. And it can essentially be extra money for your beneficiaries or liquidity, in the event that they had some other bills to pay or debts to take care of.
That's very important. You never know upon your passing how quickly or easily they can access some of the liquidity that they may need to cover some expenses at your passing. And since this is a life insurance policy, the proceeds are tax-free. And so in conclusion, right, estate planning can be very complicated, especially if you're not working with someone like Ben. And each of you, because you all have your own individual desires and concerns, it's important to make sure that your affairs are set up so that they're properly identifying your individual desires and wishes. And so making sure that you do sit with someone like Ben sometime in the future to get all of that drafted, put it all down on paper, and make sure that you've done this in a way that makes you feel comfortable, gives you peace of mind in the end, is the most important part. And it allows you to also identify not just your children, which is important to make sure that they do get what you worked hard for, but your favorite charities as well. So when you're looking for the right attorney, what types of things should you consider, Ben?
One of the ones that can help find one can be a referral from another trusted advisor, an accountant, a financial planner. Sometimes just asking people, referral or word of mouth can also be good. One of the ones that not as many people are aware of, but I think can be a good one is we're here in San Diego County. The San Diego County Bar Association has what's known as a lawyer referral service. Those attorneys are attorneys that have already been vetted. They have professional liability insurance. They're in good standing with the bar. So contacting that number and getting a few recommendations typically comes with a free 30-minute consultation. Can be a good option, at least to investigate for people. So those are all ones that can help.
Yeah. And I like to add, what we're looking for in terms of pricing, look for someone who's charging a fair fee, but isn't cheap, because especially in a situation like setting up an estate plan, you can't go back and redo it once you're gone. So you want to make sure that you're working with a competent person. Same thing with looking for a financial advisor. You want to look for someone who's a fiduciary. And so a very popular designation is a certified financial planner, a CFP, or accredited investment fiduciary, the AIF. These are good designations for people who have shown that they're willing to basically take liability for the advice that they give. And so that's important. Offering a complimentary consultation. So you want to be able to sit down with someone to see if they really understand you, if they're willing to communicate with you properly, if they can help you identify and then pass on and properly communicate your values. And if it's obviously has to be a good personality fit, right? Because this is someone that you're going to be sharing your intimate financial secrets with, right? And so you want to be very, very comfortable with them. Consider a good reputation. So again, finding a good referral from a professional that's well liked in the community can be a good source for referrals for a good financial advisor. Identifying and making sure that you feel that they understand more about these things than you do. So competency is important. And again, looking for someone who's going to charge you a fair fee. It's competitive, but isn't just giving you a cheap price, right? So what we tend to believe is more important than leaving an inheritance is leaving a legacy and making sure that you remember the important people and institutions and foundations in your life. So thank you for letting us share with you today.
Thank you.
Awesome information, great information, important information. Thank you again, Ben and Daniel, for your time and commitment to our community. And we wanted to spend some time doing some questions. Any from the audience, I'm looking for our first question. If I can go ahead and start with that. Are you okay with that?
Absolutely, it's a privilege.
How can a trust help me pass along my values? Daniel. Can you
Yeah.
address that one?
Yeah. So when we're documenting what it is that we feel, the way that we share our ideals, when we are valuing something like giving, right? One of the things that you can put into a document is you can share with your family, with your children especially, stories about what you do, how you do it. You can include them and involve them in the giving. So you're not just going to surprise them, when that box is opened and some assets are given away to an organization that they never even heard of. You can actually involve them in this process while you're alive, which is the most important thing. Is you're sharing and you're passing that along so that it continues well after you're gone.
Awesome. And we have another question. Can you put your funds in a 401k in an irrevocable trust?
Yeah,
Yeah.
that's for you.
Yeah, so great question. So the funds that are in a 401k, and a lot of times, people are concerned about, well, how do I avoid probate? Yeah, when I have all of these different accounts, and if you actually have an account that's what we call a qualified account, a 401k, an IRA, a 403b, 457, these are all qualified accounts that have beneficiary forms, and so you can just name your trust as many times a contingent beneficiary. But a lot of times the primary beneficiary will be, if you have a spouse, will be your spouse and or even directly your children, because there are some tax implications to leaving the beneficiary as a trust. In terms of actually transferring that fully taxable asset into a trust, it's not something that we would recommend, because of the fact that you would obviously owe all of those taxes. It's as if you just took it all out, and all of that 100% of that account is now considered fully taxable to you. So that tax implication for most people is too great for them to consider doing that. And there has to be some really, specialized concerns that they would want to kind of get that asset out of their estate completely for them to consider doing something like that. So it's certainly something you'd want to discuss with your CPA and or your qualified estate planner before considering.
I'll add a little follow-up comment on that. It is possible in the beneficiary designation to name a trust, a revocable or irrevocable, as the beneficiary of your IRA or 401k plan. It's not a common strategy as recommended, but it is something that can happen. It becomes very important how the document's drafted and your trustee makes the distributions according to certain standard and time period. The trust ends up paying income tax at very, very high rates quickly. So it'd be important to be making the distributions to the beneficiaries. So if you had one beneficiary at a higher tax bracket, they might still get hit, but the other ones that are a lower bracket, because the trust distributes the income out to them during the calendar year, they'll be taxed at a much lower rate. So I would consider that like an advanced planning technique, but it can be done.
Thank you both. Do I need a trust if I don't own a home?
I'll take that. On that, I would say it depends. What are the other assets? What are the values? And do you have children? And what are their ages? So if you had minor children and you might have a large stock portfolio or a life insurance policy, there it could make a lot of sense to have a trust, because you don't want your kids to receive all the money at age 18, or if they were even younger, you'd want to have someone on there that could make payments for them for school, healthcare, food and lodging. So I absolutely can see the use for the trust in certain circumstances.
Yeah, in addition to all of the powers that you're producing inside of your trusts, your legal powers, should something happen to you and you would fall ill or incapacitated, everything that comes into and is involved with a comprehensive trust is going to be there to protect you and your children as well.
Thank you. Let's see. Should I name all of my children as co-agents, co-trustees, to make decisions jointly? That's a tough one.
This is a question I get a lot, and it's a common wish of a lot of parents. We almost, uniformly advise clients that it's better to name a succession
It's possible to treat all your children equally in the document in terms of who gets what, equal shares among all of them. But the burden of being the trustee, it's really just a huge responsibility. People think it's something they want, they really don't. It comes with a huge amount of risk, and it's a lot of work. So you really want to name the one that's the most qualified. And by naming one, you give them the ability to move the case forward and finish everything out, get everyone their funds, even if something unexpected comes along. When you name them as co-agents or co-trustees and there's disagreement, there's just a huge gridlock action. And the only real way to resolve that is to go to the probate court and fight about it. And, that's one of the main things people are typically trying to avoid when they set up an estate plan.
Yeah, too many instances where we've seen that the parents think, oh, they get along very well. There's no problem, no issues. We don't have to worry about that with our kids. And then money's involved and decisions are involved, and all of a sudden they don't get along so well. So it's best to not really put that on them, like Ben was saying, put that burden on them when you have the opportunity to choose right in advance.
Wonderful. All right. I've heard that if I transfer my property to my children, I may be able to protect my property or even qualify for long-term care benefits from the government. Is that true?
Oh, do you want to, Daniel, or you want me to go?
Go ahead. You can start. Yeah.
So, there's a whole area of the law, in addition to estate planning, known as elder law or Medi-Cal planning. Sometimes people have private long-term care insurance, but here we're talking about the state run one that comes from the federal program of Medicaid. California, the implementation is Medi-Cal. And there's a variety of planning techniques that are used. Sometimes you set up a life estate, you reserve the right to live at the property during your lifetime, then it passes to your kids. And other ones, you might make a gift to the property while you're alive to your children, or set up an irrevocable trust type gift to them. But it is a specialty. The rules are constantly changing. Depending on when you make the transfer, it could even disqualify you for the benefits. So this is one that's really important to hire someone that's a specialist on that.
Yeah, in addition to the fact that your property, you may not be a very high risk person, especially if you're retired, for example, versus your children, they may have high risk careers. So whereas your property was not exposed to risk, now you've actually exposed it to risk. And when a lot of people think long-term care, they're thinking in terms of just their traditional health benefits. And so there are a lot better ways, if again, we're talking about properly planning things in advance, there are a lot better ways to plan for these long-term care or healthcare issues than making these transfers, especially if you're not sure exactly what the repercussions could be long-term.
All right, great. Does transferring my property to a trust require me to give up ownership?
Typically with revocable living trust that we spent a lot of time talking about, no, you would continue to own it, control it. You decide to sell it, you'd be entitled to all of the proceeds. Little things could come up, like you go to escrow and they say, hey, I need a copy of your trust, or I need you to complete this 2-page form so I know who's authorized to sign on behalf of the trust. That will seem like a lot of paperwork to people, but really in terms of the benefits that you're getting, it's you have complete control during your life.
Especially again, the revocable living trust, we like to say you're basically just taking your assets, your cash, for example, from one pocket and just putting into the next. You still retain all the control, which is what you want, especially with your investments. You're going to continue to manage your savings, your investments, all of your property the same way that you managed it before. You're just adding a little bit more organization to it.
Thank you. So does a trust help me with my taxes?
Yeah, we get this question all the time, and unfortunately, right? It can, certainly can depend on the type of trust, but the reality is, again, it's completely passed through, and so you're going to pay the taxes the same way that you pay your taxes now, because you continue to control the asset. And so when it comes to tax planning, there are other things to consider outside of trusts. And again, the types of trusts that Ben even alluded to in our webinar, the types of trusts that we talk about for tax planning are more of an advanced situation. Right, Ben?
Yeah, I agree with that. And I mean, when you get into higher net worth people, I mean, there can be estate and gift taxes, and there are some complicated strategies you can do using irrevocable trust to try to reduce those. But in terms of income taxes, pretty much everyone is entitled to the step up in basis, regardless of whether you have the trust or if the case went through probate. So, or if there was a beneficiary, so that benefit is available to everyone.
Great. Let's see. What is the difference between a trust and a will? Basics.
So the main difference I would say is the will much more often be administered through the probate court. The trust can often completely avoid the court administration process. And just giving an example, let's suppose simple, all I have is one single family home. Well, one single family home in San Diego is probably worth $700,000-800,000 these days. And you know, the cost of probating that between the attorney's fee, the executor's fee, other court costs probably exceeds $50,000. You compare that to the trust process, it's probably, I don't know, 5% of that or 10% of that, much, much less. So I would say that the trust can end up saving a ton of costs, you know, getting comfortable with a little more complexity of setting up initially.
Daniel, anything to add? Good.
No, that's very clear right there.
All right. Will I be able to pass my Prop 13 property tax benefits to my children and grandchildren?
There was some key update on this one. So the way the law was in California for many years, it was very favorable. Each parent could pass not only the principal residence benefit, meaning they have Prop 13 benefits on their house. They're paying $1,000 a year property tax on a market value that would be, say, $10,000 a year. They were able to pass that to their kids. Then they were also able to pass $1 million of assessed value worth of property, rental properties, or other properties to their kids with no increase in the Prop 13 taxes. And that all changed last fall. There was a ballot initiative. It completely eliminated 90% of this. There's now a very limited Prop 13 benefit still available for the principal residents. It started February 16th of this year. It just went into place. We're already seeing it in the office, and it's a lot of requirements. So the first requirement is that the person that passed away was living in the property as their principal residence. And then the second requirement is that whoever's receiving this property also occupies that property as their principal residence. And if they don't, then you don't qualify. Property taxes go up to market value, and you can imagine it could be a big swing.
So again, you know, when you're looking for tax planning, or you're looking for all of these different strategies, and you don't know what the actual laws suggest, you could be making, you know, wrong moves that you thought were going to help your family long term, and they ended up not really providing a benefit. So a lot of times it's really looking and speaking with an advisor, a counselor, to get an idea of what you're looking to accomplish, and then having them, these professionals, experts, help you come up with the right strategies.
So getting guidance is key. All right. Will a revocable trust protect me from creditors?
The answer on this is no. There may be potentially some privacy benefits. Some people name their trust a different name than their last name, and maybe it's harder to find in the public records in terms of real property, but there's no creditor protection. It's what's known as a self-settled trust. A lot of clients or potential clients in the past, they come in, they're under the impression that they can never get sued again once they set this up, and that's not the case.
And also, Ben, what happens to the debt of the individual that passed away? A lot of people think that there's some issues that are going to arise if I didn't pay off all my debt when I pass away. What happens to that? Just like typical like credit cards.
It gets a little complicated, but the basic idea is if you do not follow, you know, any claims procedures set up in the probate code, either as part of the probate case or a trust administration, there's a hard 1-year statute in California in terms of pursuing, you know, a debt that was owed by the person that passed away. Here's a key exception, obviously, real estate mortgage. the real estate mortgage will have to be paid off when the house is sold, whether the house is sold 11 years after you die or 6 months after you die. But other things, credit cards, hospital bills, those kind of things, it's a hard 1 year creditor's claim statute.
Right. Right.
Awesome. I think those are all the questions from our audience. Thank you both so much
Thank you.
for your time and your expertise. It's invaluable. I'm so glad that you're part of our Southwestern College Foundation too. And if you want to connect with Daniel or Ben, please let us know. We'll get you connected. And just to wrap it up, Southwestern College is such a gem in our South Bay. We're the only institute of higher education south of the 8 and serving so many people, and there's so much potential for our students. So the foundation will continue our efforts for students, and you are partners. Remember, when you sit down with someone like Ben or Daniel, consider Southwestern College as you're preparing your planned giving. In fact, we are adding a link in the chat to our pledge form. It's in the chat box so that we can give you the benefits of a future gift. So lots to look forward to, so exciting. And again, thank you to Ben and Daniel for presenting, and we will see you again soon. Thank you.
Thank you all.
Thank you, Sophia. Thank you, Daniel. Thank you, everyone.